Hello and welcome to the Mint Funds and Market Update. My name is Ryan Falls and I'll be taking you through the market outlook from August and then how the funds performed over the month. Cool. Starting off in the US, we had some mixed signals on the dreaded tariff inflation coming through in some of the headline measures. So in this chart here, we have the rolling 3-month annualized numbers for three of the, leading inflation indicators. We have headline CPI in the light green. We have the PC deflator, the Fed's preferred inflation measure, in the gray. And then in the light blue, we have PPI, which is the producer price index. So it's a reflection of businesses' input costs for producing goods. So as you see of the pink line here, we have marked the Liberation Day announcements, which was the beginning of all of the tariff events. And effectively, we can see that we haven't seen a marked increase in the 3-month annualized number for any of these inflation indices. However, for July, for the month of July, which was released in August, we could see that the CPI and PC numbers effectively stayed fairly steady at around 0.2 and 0.3 month on month. But if we look at the blue line, which is the PPI number, we can see that it actually increased from 0.4 to 0.5 over July. Now, this doesn't necessarily mean that inflation is starting to take hold again, and a lot of market commentators were focused on the potential for stagflation on the back of these tariffs and the pass-through to prices on consumer goods. However, we're still seeing mixed signals on that actually materializing, and we'll be watching these indicators going forward to see if there's any kind of increase in the trend for inflation getting passed through in the US. Turning to the other big event in August, is towards the end of the month, we had Jackson Hole, and all eyes were on Jerome Powell, the chair of the Federal Reserve, who in his speech duly delivered on hinting at upcoming interest rate cuts. Now, he was not very specific on the timing or the amount, but effectively markets were looking for some signal or hint from him that the Fed may change its positioning of staying static and maybe move to a policy less restrictive. So I guess the chart on the left-hand side just effectively shows how that materialized into market pricing. So effectively here what you have is market pricing for what the market sees as the effective Fed funds rate, so the effective midpoint. The dash line in green shows where it was a month ago, so towards the end of July, and the red one shows where it was at the end of August. And as you can see, markets have effectively priced in one more cut towards the terminal pricing point around Q4 2026. And it effectively all but confirmed a cut in the September Fed meeting. So much so that I think there is effectively two cuts priced in effectively by the end of the year. Some of the key takeaways from Jerome's speech was that they are opening the door to cuts from their current position. The market's favorite line was that the time has come for policy to adjust. Jerome mentioned risks continue both on the inflation and labour, so the Fed's dual mandate, but the focus now appears to be shifting away from inflation to the labour market. And again, as I mentioned, he's effectively open on the amount and timing of future monetary policies. And so yes, the timing and the pace of rate cuts will depend on incoming data, the evolving outlook, and the balance of risks. Market pricing after the meeting have priced in 88% chance of a 25 basis point cut for the September meeting, so after that speech. Turning to the labour market and some of the data out of there that made Powell change his tune. At a headline level, unemployment seems fairly fine at around 4.2%. But there are some signs there may be turbulence ahead. So I have two charts here, and on the left-hand side, we can see the 3-month moving average of the monthly change in non-farm payrolls. So the grey shaded areas within this chart indicate prior recessions, and it doesn't take much charting knowledge to have a look to see that when that line, effectively that 3-month moving average line, the blue one, crosses below zero, it tends to lead to recessionary conditions within the US economy. So as you can see, as at the latest results for July 25, so reported in August, we can see that we're flirting very close with that line, and it's been quite a marked drop since the years 2022, 2023. Again, this isn't flowing through as yet into the headline unemployment number, But if we look again at the right-hand chart, which does plot the unemployment rate on the right-hand side axis, and we look at the blue line, which is a measure of jobs plentiful minus jobs hard to get, which is derived from an employment survey, we can see that this is a measure of how easy it is for people in the labour market to actually get a job versus how hard it is to get one. Now, in times of recession, again, shaded by the grey bars here, the two lines tend to cross over. So effectively, it gets harder and harder for people to find a job, and the number of people saying the job's hard to get increases. And that corresponds, obviously, to a higher unemployment rate, as those people that find jobs hard to get remain unemployed. As of yet, the blue line is still quite high relative to the red line, so there's still some ways to go. But yes, effectively, what we're seeing is that there is some small signs of warning from the labour market, and again, that kind of coincides with what Powell and the Fed are seeing in terms of labour market risks going forward. However, in the Q2 earnings season, it appears that Wall Street is not the same as Main Street when it comes to the general economy. Wall Street and general companies within the S&P 500 do appear to be shrugging off any perceived tariff or trade barrier impact thus far in their latest earnings season. So what we have here is two charts which effectively show by sector what the earnings results were versus expectations on the left-hand side. So the green bars indicate an above earnings result versus expectations based on FactSet expectations. The yellow is in line and red is obviously a miss. Now, just the first thing to obviously point out is that the majority of bars across all sectors, I guess bar the last one, which is materials sector, appear to be all beats. So that you can imply from that effectively companies are still producing strong earnings. They're beating analyst expectations, and any of the perceived, I guess, retraction in company earnings has yet to materialize in this quarter's earnings season. However, we'll obviously keep a marked eye on that going forward. On the right-hand side, just to prove the page to the notion that companies maybe undershoot on future guidance, and then when they have realized earnings, they easily can beat them. This actually shows the earnings growth year on year for Q2 2025 versus Q2 2024. And effectively, in absolute terms, we can see the dark blue line effectively represents the year-on-year growth against the grey line, which was from Q2 2024. And as you can see, by and large, most of the sectors, except for materials and energy, appear to be growing earnings at a rate that's substantially above zero. Obviously, that changes depending on the sector, but just to ensure that the view is that earnings have went backwards or contracted, it does not appear to be a case across the wider S&P index. And given the fact that communication services and info technology tend to be a larger chunk of the overall index, we can see that this explains some of the recent performance within the overall S&P index. Turning to New Zealand, within August we had the RBNZ MPS, so there was a dovish pivot with the terminal rate lowered. Terminal OCR was lowered to 2.55% per the MPS forecasts, and effectively two more cuts were forecast by year end 2025. RBNZ also cut by 25 basis points within that meeting. What we have on the left-hand side here is a chart showing market pricing for OCR and also then an ANZ forecast. But effectively, what I want to draw out of this chart is that the market pricing on the 20th of August, which was the day before the meeting, was effectively a terminal rate of somewhere between 2.7 and 2.8, so effectively 2.75. But post the meeting and the subsequent press conference, markets have well repriced and effectively have coalesced the view from RBNZ that the terminal rate will be 2.5%. So this is an extra 25 basis points than previously expected. Looking now at the right-hand side, this is just drawing on the forecast that RBNZ provide as part of that MPS. So this is a forecast of the year-on-year GDP number production method. And what you can see here is that effectively RBNZ recognized that the economy may not have been growing as strongly as they previously forecast in their previous MPS forecasts. And you can see that the difference in the forecast for Q2, Q3, Q4, 25, and subsequently into 2026 has actually decreased. So that this effectively is the RBNZ recognizing that there may be more monetary policy relaxation that may be needed to stimulate the New Zealand economy. Now, turning now to the two Mint diversified funds, and we'll start with the income fund. So asset class performance was mixed in August as long global bonds rose and markets awaited the outcome of the Jackson Hole speeches. Looking at individual asset classes, we had fixed income up 1.1% and global equities up 0.1%. And they're the top two positive contributors, with Australasian equities are a negative contributor, negative 0.3%, giving an overall fund return of plus 0.9%. Looking at the positive side of the portfolio, within global equities, we had CVS Health Corp up 17.8% and CRH PLC up 18.3%. And they're the two leading names for the month. CRH had a strong start to August as they reported their Q2 earnings. The revenue was a small beat versus expectations, but the stock surged primarily on a revision to future guidance for the rest of the financial year 2025. Within Australasian equities, we had Charter Hall Group was up 16% and SRG Global was up 18%. Charter Hall has strong financial year 2025 earnings update with EBITDA up 7.1% versus expectations, and then the dividend per share up 6% year on year. Within fixed income, again, we had that dovish pivot at the RBNZ's August meeting, where they lowered that implied terminal OCR rate to around 2.5% by the end of this year. Our tactical overweight at the short end of the curve with OIS swaps contributed 35 basis points to overall fund performance. Turning now to the negative contributors, within global equities, Oracle dropped 10.9% and SAP dropped 7.5%, and they're the two main detractors from performance. SAP dropped as markets appeared not to react positively on news in the start of the month of SAP's latest acquisition target of Smart Recruiters, which is a talent acquisition software provider. Within domestic equities, we had Telex Pharmaceuticals down 30.6% and CSL Limited down 21.4%, and they're the two worst performers over August. CSL sank on their financial year 2025 earnings report that came out during the month, with some negative headlines dominating, particularly the reduction in the lower research and development spend, and then some temporary factors inflating current results. Turning now to the Mint Diversified Growth Fund. So again, obviously asset class performance was mixed in August. We had global equities up 0.9%, fixed income up 0.2%, and they're the top two positive contributors, with Australasians equities are a negative contributor, negative 0.3%, giving an overall fund return of plus 0.8%. Looking at the positive contributors within global equities, we had again CVS Health Corp up 17.8% and CRH PLC up 18.3%. CVS had a strong August after starting off the month beating market expectations in their Q2 earnings call. Their revenue beat was up 4.7% year on year. Operating income was up 20%, and this is all above consensus, and their future guidance was also upgraded. Within Australasian equities, Charter Hall Group was up 16%, SRG Global was up 18%. SRG actually had a record financial year 2025 result, which is well ahead of expectations, with a further plus 10% growth in financial year 26 guidance. And that was led by strong margin growth and successful integration of the Diona Limited acquisition. Again, within the growth fund, we had fixed income, that dovish pivot within RBNZ meeting, where they lowered the implied terminal OCR rate to 2.5% by the year end. Our tactical overweight in this fund also helped the short end of the curve, with OIS swaps contributing 8 basis points to overall fund performance. Looking at the negative contributors within global equities, again, we had Oracle Corp down 10.9% and SAP down 7.5%. Oracle gave back some of its recent gains as the market anticipated its first quarterly result for financial year 2026 at the end of August. But there were some reports that their AI cloud expansionary drive had been driven by reducing headcount and slashing costs within the business, and markets reacted poorly to that news. Within domestic equities, Telex Pharmaceuticals was down 30.6% and CSL was down 21.4%, and they're the two worst performers for the month. Telex had a poor end to the month despite a decent earnings report, which was overshadowed by an announcement that the US FDA had identified disclosure issues related to the manufacture of Xerocax. However, it appears to be a technical issue, and revenue guidance at this point remains unaffected. Thank you very much for listening. If you have any questions or any queries, please feel free to email us at info@mintasset.co.nz. Thanks very much.